Hey guys, it's Big Mike. As always, I want to thank you for being here today. And today we've got Traders Accounting to come talk about tax. I know it's everyone's favorite subject. In fact, I was running a poll for the last week or so on the forum. Here's the results of the poll. I simply asked, do you do your own taxes? Do you pay someone else to do your taxes? Or do you do you think that they're unconstitutional and you don't pay them? That may also apply in some cases if you're outside of the states. All right, so interesting poll. And today we're talking about tax. Specifically, we're talking about trading as a sole proprietor. We want to talk about the IRS special rules surrounding trader status and the advantages and disadvantages of trading as a business, as well as the types of businesses that you can have as a trader, like partnerships, LLC, corporations, etc. And also a popular question that will be addressed today is trading in a retirement account. So today, Bob at Mirus Futures is going to do a very brief introduction about Mirus Futures, and they're here because they are the ones that have brought Traders Accounting over to BMT. Once Bob is done, we're going to turn things over to Trace Bueller at Traders Accounting, and he'll get started with his full presentation. As you guys have questions, please type them into the box. We'll do the best we can to answer everybody's questions. If you have any questions about Mirus, be sure to type them in at the beginning of the webinar, and then we're going to turn things over to Traders Accounting after that. The webinar is being recorded like always, so if you miss something or if you have some type of technical issue or need to step away, you can come back sometime tomorrow on the forum, click on webinars from the top of any page, and view the recording. All right, guys, 1 second, and I'll be turning things over to Bob at Mirus Futures.
Hey guys, my name is Bob with Mirus Futures. Bear with me very briefly while I start sharing my screen for you. I want to thank Mike, first of all, for allowing us in the room, and very excited to be working with Trace and the entire team over at Traders Accounting to bring you the presentation today.
Hey, Bob, you should be able to share your screen now. That was my fault.
Perfect, no problem. Just select the correct monitor here. Perfect. So again, thank you to Mike. Thank you for Traders Accounting. I just wanted to do a brief introduction to Mirus Futures, especially because, as you all know, when trading futures, there tend to be quite a bit of name involved. And one of the things that we like to do as brokers is kind of separate the different parties and what they're responsible for. So, as I mentioned, Mirus Futures is an introducing broker. Really, our main focus is providing you guys with the tools necessary to make the trades, to trade your account. So we're going to be providing you with front-end software. That's the platform that you would use to click the buy or the sell button. We're going to use the trading engine, and for Mirus clients, we use Zenfire for market data and execution. And that's really your connection to the exchanges. While the front-end software is there to allow you to visualize and do market analysis, Zenfire is the network that connects you to the exchange so that you can get your orders into the market with great ease and efficiency. We also handle the risk management in-house. A lot of brokers rely on the clearing firm for this responsibility. We run things very efficiently, and Zenfire gives us that for managing risk in-house. We're also your customer relationship managers, so if you have questions on any of those tools that we offer, you're going to be speaking with us. The clearing firm, on the other hand, is really mainly responsible for three different things: holding clients' funds in a segregated bank account in the name of the client, clearing trades at the end of the day, and providing daily and monthly and year-end statements to their customers. So this is a key point for today's topic, because doing taxes, we all know that we're getting to that time of year, just over a month left before we have to get those in, where we're going to be using the statements that were provided from the clearing firm to help us in doing those taxes. Futures is very easy comparatively to other investment classes, where you're really detailing out the different trades that you've taken. You really only need to provide the year-end statement to your tax advisor, but Trace will be speaking about that, I'm sure, very, very briefly. I do invite you to check the demo accounts of Zenfire with any of the front-end platforms that we offer. We work with a number of different software providers that can connect you to the exchanges through Zenfire. So you can register directly on our website to take a look at a 30-day demo account. In addition to the live trading solutions, we do offer a number of other services. Trade assist programs, where a third party would create an automated system that's run by Mirus in-house. Manage futures, you would work with a CTA who has devised a trading plan and is registered with the regulatory body, the NFA, for auditing purposes. We also offer full-service brokerage to any client who's wanting to get a full daily report on the markets they're wanting to be involved with. In addition to that, we do have some free daily technical research to any of our clients. We also offer a 30-day demo of the daily technical research. We have a number of different education platforms. Again, we work with partners like Traders Accounting to provide you guys with the tools necessary to enhance your ability to trade. And it's working with these partners like Traders Accounting that really add value to all of our clients. If you are an automated trading developer, and you're doing that from within a sole proprietorship, a corporation, or through a trust, you can co-locate with Zenfire and the exchanges to remove the latency that the internet adds for not only market data but trade execution. Over the last 7 years, Mirus Futures has grown our reputation to provide the tools necessary for trading, but also the support and customer service that you've grown to expect of us. So we do this through online support material, training videos. Our support team does have the ability to log in remotely with our users to resolve any issues that they have. Again, we do host live weekly webinars, and feel free to check out that 30-day Zenfire demo account. If you have any questions about our technology or services, feel free to send us an email or give us a call, info@mirusfutures.com, or just check out mirusfutures.com for more information. Thank you, Mike, for having us to introduce Trace. And Trace, I will kick it over to you now.
All right. Thanks, Bob. So if anybody has questions for Mirus, there's the email address. And Bob, give me 1 second, and I'll take back control and then hand it over to Trace.
Sounds good.
Okay, hello everyone. This is Trace with Traders Accounting. Is the sound still okay? On the comment box, if you would put in a yes if you can hear me. Very good. Thank you very much. I appreciate you guys' participation. And we're looking at the introductory screen, Why Trade as a Business? Tax Efficiency. Can you see the screen with Traders Accounting? Please type a yes in the box. Very good. Let's see if it actually works. Now we're on to the next screen. What I'm here to do today, folks, is to stop the bleeding in your trading accounts. What do I mean by that? Well, let's look. If you're going to start your trading career and plan on being in this business for any length of time, 5, 10, 15, 20 years, you definitely need to be trading as tax efficiently as possible. Otherwise, your accounts are just going to bleed to death. Here's what I mean by that. If you took your trading account and started with an illustrious $1, but you were such a good trader, you were able to return 100% consistently year in and year out for the next 20 years, even if you just start with $1, you would, if you were to double that dollar in every year for 20 years, that trading account would grow from $1 to over $1 million in 20 years. That's the power of compounding interest, right? But on the other hand, if the trading account were taxed every year at 35%, you take your same trading methodology, that same dollar doubled every year but taxed at 35%, then in 20 years you're not looking at $1 million brokerage account. What are you looking at if you pay tax every year? Just over $22,000. That's what I mean by the bleeding in your account. This is what happens when you tax the account. It eats into that compounding effect. So instead of doubling it every year and going from $1 to $2 in the first year, you went from $1 to $1.65. And then your second year, you're not doubling it. You're getting a double rate of return. You're getting 100% rate of return, but you are losing a significant amount of that compounding effect. And so you have your tax savings no longer compounding, but you're getting taxed to death. Here's what we call a tax-deferred account. Here's your IRA. Here's your 401k. Tax-deferred, tax-free for the next 20, 30 years, however long you've got left in your trading career. Here's where you're at if you're trading in your own individual name. And I guarantee you on the other side of those trades that you're making are people trading out of 401ks, trading out of corporations, limited partnerships, LLCs. So what we're going to do today is show you how to stop the bleeding out of your accounts. My name is Trace Bueller. I'm with Traders Accounting. That JD behind my name is a law degree I received in 1992 from the University of Idaho. I began my career with living trust and helping people eliminate their estate tax. But what I quickly learned was that people were more concerned about income tax than they were with their estate tax. And so I went on the seminar circuit and I began teaching alongside of educational firms that taught people how to trade. I met Jim Crimmins on the seminar circuit in 1997, and Jim started Traders Accounting in 1998. He is a pioneer in this industry. I'm very proud of Jim. I'm very proud of Traders Accounting. And what we're going to do today is talk about eliminating the taxes to the full legal extent possible. Here's our information, our contact information, my email address. We always begin with a disclaimer. Even though we are a tax and accounting firm, we're not a law firm. But you will have an opportunity to sit down with us and or your tax advisor, your tax attorney, your CPA. They can also get on the phone with us and we can discuss these strategies that we're talking about all in a conference call to see if any of these strategies that we're talking about today have specific application to your situation. We are not a law firm. We're not giving legal advice, but I'm trying to educate you and show you just some basic financial terms that you as a trader need to be aware of. Just the basics. Why trade out of a business entity, for instance? Well, I've had several clients tell me that, you know, Trace, after I started the business, I trade a lot better. I'm more disciplined. I'm more organized. So we're seeing a lot of that just inherently by beginning a trading business and formalizing it with the formal trading entity. But mostly, clients come to us wanting tax savings, and so we set up the business, we set up your trading enterprise inside of a business so that you get more deductions, so that you get the tax deferral like we just illustrated, so that the business entity can get trader and security status. And with that status, we can then make the mark-to-market accounting method. We can elect mark-to-market, and we get the deductions associated with a trading business, like trading education and all of the expenses that we have in learning how to trade and maintaining our trading enterprise. And then lastly, you've got some incidental but very important asset protection, privacy, and even a little bit of estate planning, because after all, a corporation will survive you, right? You all heard of the Henry Ford Corporation? Exactly, it survives you, and so you can use your business to do a little bit of estate planning because the corporation does not go through probate. It's just the assets in your name that would end up in probate court. And then lastly, it is easier to attract trading capital, either in the form of debt or equity, when you have, of course, a formal trading business. What is a business entity? Here are some of the most common business entities. Trusts a lot of times become and evolve into an entity. An individual, each of us are recognized in the laws of this country as being individuals, entities that can sue and be sued, can enter into contracts. So each of us is technically an entity. The problem is that as an individual, you are thrown into, you're defaulted, actually, how convenient, but you're defaulted into the worst possible tax situation. Other types of entities include limited liability companies, S-corps, limited and general partnerships, C corporations. What's the difference? Basically look at it this way, guys. The arrows beneath the boxes represent the entity itself. The LLC, the S-corp, and the limited partnership, see how they have arrows going out of those boxes? That means that the entity doesn't pay the tax. Sounds good, right? Limited liability companies, partnerships, they do not pay income tax, period. Never do. Who pays the tax are the owners. And so those arrows are pushing all of the earnings and the losses and the expenses onto the owners. So in effect, you have an LLC and it's trading in the market, and all of the income from that trading business, the tax on that income is paid by the owners. Now, you notice in the S corporation, we've got a red arrow and a blue arrow. The red just simply is there to indicate with a sub-S corporation, the owners get paid a salary and a dividend. With trading, you can pay yourself with profit distributions, basically all as dividends, all as unearned, and avoid self-employment tax. An S corporation, it's not like that, folks. You have to pay a salary out of an S corp. You can pay some dividend, but you must pay a salary. That's exactly why we don't encourage people to trade out of an S corporation, because trading inherently is unearned income. It avoids self-employment tax. It avoids Social Security, FICA, Medicare, Medicaid tax. So you're effectively penalizing yourself if you force yourself into paying yourself a salary. Why not instead pay your trade as an LLC and let the LLC push those trading profits as earned income to you. No self-employment tax, no Social Security, no FICA, no Medicare. Same with limited partnerships. Now C corporations, you'll notice there is no arrow under that C corporation. The C corporation pays a tax. It pays its own tax. And we're going to talk about today how to take advantage of these little nuances in these entities to reduce and eliminate your income tax. With each entity comes a certain amount of paperwork. The nice thing about being a sole proprietor is you have no paperwork. But the bad thing is you're an individual and you're by default thrown into the worst possible tax situation. Trusts sometimes have paperwork, sometimes they don't. You can walk into a bank and say, I'd like to set up an account for the rest of my life and then have the remainder go to my niece or nephew in trust. That is a trust agreement, a verbal trust agreement. We never recommend that, but you could set up a trust without any documentation. Same with the general partnership. You can agree to go into business with a person, and if you set that up and get a tax ID number, then you are effectively a general partnership. That is the worst possible entity to be involved in. Why? Because you didn't reduce your liability exposure, you increased it. Because a general partnership, each partner bears the liability of the partnership and the other partner. So you just took on all the other partners' problems and creditors, et cetera, et cetera. But you could set that up without paperwork. All these other entities, of course, have articles, bylaws, minutes. Very easy to do, especially when you have a firm like us, generate those documents and step you through them. Included with the documentation is a federal employer identification number, EIN number. It's 9 digits long. It takes the place of your 9-digit Social Security number. And so each of these entities goes out and gets an employer identification number, even if you never have a single employee. Kind of nice, but that's what the IRS likes to call it. And that is the same thing as a tax ID number. That's the number that you want to use. That's the number that you want to trade under. That's the number that goes to the broker. That's what you want to be trading under, is under that tax ID number. That's what makes all the difference in the world. You are taxed on your income, the income that comes to you and your Social Security number. Okay. What is not an entity? Sole proprietorships, not an entity separate from you. That's part of you. Single member LLCs. This is kind of a thorn in my side because attorneys today are setting up single member LLCs in California, Florida. We see it all the time. They have no idea what tax consequence they just put their clients in. It seems because a single member LLC is disregarded by the IRS. They will tax it like a sole proprietorship. Not too bad. Not too bad of a consequence unless you're a trader. If you're a trader and you're taxed as a sole proprietor, then what happens? Well, the IRS gets your return and says, oh, isn't this interesting? We've got this this individual, he's got all of his expenses on Schedule C, but there's no income. Oh, wait a minute. As they say when you're sitting across the table now, they've called you into the office. Oh, now we see your income is on Schedule D. Oh, okay. Well, now that we've got you in here, let's just do a full-fledged audit. So sole proprietors, individuals, Schedule C is the biggest red flag out there. And so when you trade out of an entity, you immediately lower your audit profile. And then the other thing to consider about being a single member, one-person member LLC, is that they are being disregarded by the states. So that means that the state is not going to honor the asset protection that you would otherwise have had you had a legitimate partner. But don't worry if you don't have an individual that can be a partner with you, if you don't have a spouse, if you don't have a family member, you can use another entity to be your partner, right? And I'll show you what I mean by that. You want to have a multi-member LLC, 2 or more members. So if that's your spouse, then you can be 50-50 with the spouse. Doesn't matter. You're married filing jointly. It's all going to hit your 1040, but it's going to hit it after deductions. But nonetheless, if you're using another family member, you may just want that family member to own 1% of your LLC, and that's completely fine. You would then own 99% of the LLC. Now, if you don't have a family member, you can use a management trust. It's a trust that we generate. It costs about the same as an LLC. There is some additional cost because we've got to set up the trust, and you're the trustee and you're the beneficiary of the trust, but the trust does get a tax ID number. We get it for you, but then you have a separate taxpayer, and then you've got a multi-member LLC. Or, better yet, how about this one? How about we have your trading account put in the multi-member LLC, and you just own a small percentage of it, and let a major percentage be owned by a C corporation. Then you've got the best of both worlds. You've got an LLC trading, it's paying out unearned income to you, and then it's paying the corporation to manage it because the corporation is the LLC manager and the corporation is the owner. Whether that be 90%, 50%, it really depends on your personal situation and how much income we're talking about and how much expenses we can take by taking them out of the corporation. So more on that in a minute, but why we're doing this, why are we doing all this? Well, taxes is a bigger expense than food, clothing, and shelter combined. It is your largest expense. You need to know these basic terms, basic terminology, so that you can reduce this huge expense that you're paying out, whether you know it or not, whether you feel it or not, whether you notice it or not. If you're working a job, it's very convenient. The IRS loves it. The employer pays the tax, takes it right out of your paycheck, but it is by far your largest expense. Now, when it comes to trading, it's even more crucial than the average American, because when you talk about trading business, you're talking about taxes as taking out of the inventory of the business. If you don't have to pay tax, if you can save $1 on tax, that's another contract or two. That's more inventory that you can buy and sell in your trading business. But Albert Einstein said it best when he said, you've got to learn the rules of the game and then simply play better than anybody else. Just as important to your trading is some of these tax concepts we're going to talk about today. Just as important to your fundamental and technical analysis are tax consequences, as I hope you've seen, but I'm going to show you once again. You take your trading account, you have no tax, you're going to double that, and you're going to compound your tax savings. If you don't, you're going to be taxed every single year at 35%. Well, is it really 35%? Let's take a look at the taxes. In this country, we have not one, not two, but 3 types of income tax. First of all, we have federal income tax, of course, that ranges anywhere from 10, 15 to 35%. Those of you in the highest tax brackets are paying 35%. On top of that, in addition to that, you've got state income tax. Those of you lucky enough to live in Nevada, Wyoming, South Dakota, Texas, Florida, have 0 state income tax. But those of us that live in California, Hawaii, Massachusetts, we're talking double-digit state income tax on top of the federal income tax. So you tell me how much tax you're paying. Is it really 35%, or could it be more? And then on top of that type, those 2 types of tax, you've got FICA tax, Social Security, Medicare, Medicaid. Those are all the kinds of taxes that we lump in and call self-employment tax or FICA tax or Social Security. That is levied on at 15.3% on your first $106,000. of earned income. Let me say that again. This is an important one. Social Security tax, FICA, Medicaid, self-employment tax that is levied on your first, let's just keep it easy to remember, your first $100,000 of income gets thrown up against first $100,000, of earned income is going to be subjected to FICA tax. Now remember, trading is short-term capital gains. Trading is unearned income. What's unearned income? That's like rent and royalty income. You write a book and get royalty income from the publisher. That's not earned income. You don't pay Social Security tax on that. If you rent out your property, you landlords out there know this already. You don't pay Social Security tax on your rental income or your dividend or interest income from your investments from your bank accounts. Nor do you pay self-employment tax on profit distributions coming from a trading LLC. Don't you love that? Okay, more on that in a minute. But with all these different kinds of taxes, that may leave you feeling just like Will Rogers. Thank God we don't get all the government we pay for. That is going to be our new mission statement here at Traders Accounting. Okay, so how are traders taxed? Generally speaking, you're generating capital gains, not earned income, short-term capital gains. What are capital gains? Anything held over a year is considered a long-term capital gain, taxed at the maximum 15% federal rate. Short-term capital gains are those instruments that are traded within a one-year period. And what are short-term capital gain rates? There are none. They are taxed at your individual tax bracket. So your short-term capital gains, your stock trading, your, I want to say futures. Futures, as you know, have a 60-40 split. How do you remember this? Well, 60% is longer than short. So 60% long-term, 40% short-term for those of you that are trading futures. That's defined under Section 1256, commonly referred to as a 1256 contract. What has happened is you can thank your broker, you can thank Mirus and the exchanges for lobbying Congress and winning and getting a better tax treatment than anybody else. And what is that tax treatment? It's 60% long-term, 40% short-term. So instead of saying 60% taxed at 15% and 40% taxed at your rate, it's usually easiest, clearest to explain this in an illustration. If you make $100,000 trading futures, $60,000 would be taxed at 15%, and the remaining $40,000 would be taxed as a short-term rate, which would be your federal income tax bracket, whether that be 15, 28, 33, 35%. So you've got definitely a better tax treatment when you're trading futures. Some other things to consider when we're talking about trading futures. And by the way, if you're trading stocks or Forex, and I don't care about options. Options tax is depend on the underlying. So if you're trading options on futures, just tell me that you're trading futures. But are there any listeners on this call that are trading anything other than futures? Do we need to go into Forex? Do we need to go in stocks? Or should we just cover futures? Can you guys let me know in the comment box, please? Okay, we do have some foreign exchange traders, trading cash, trading spot. Some of you may be trading foreign exchange futures. I understand that. Options, okay, and we do have some stock traders. Okay, I appreciate that. Thank you very much, Spot Forex. If you're trading futures, here's your screen, and I'll bring up the foreign exchange and the stocks here in a second. Futures, 1256 contracts, Section 1256, 60% long-term, 40% short-term. And like Bob said from Mirus, you only identify your broker and you put that your net gain, net loss on Form 6781 That's the form that breaks out into 60%, 40% for you. Okay? If we do your taxes, obviously we're going to do that for you. And all of your open positions held over the new year is considered closed for tax purposes. So it would be impossible to have a wash sale, right? No wash sales for futures, 60% long-term, 40% short-term. For this reason, for the reasons of not having wash sales and having a 60-40 split, most futures traders do not elect mark-to-market. I repeat, most futures traders do not elect mark-to-market. Why? Because they would have to give up that 60-40 split, and the only benefit would be to have the capital losses be treated as ordinary losses and deductible against ordinary income. If you didn't catch that, I'm going to repeat that several times today. Okay, those of you trading foreign exchange, this is how most people consider trading. Oh, I'm just making money and I'm losing money, but whatever I lose, I get to deduct, and whatever I make, it shows up as income, right? No, only Forex works that way. Only foreign exchange works like you think it does. We had a client come to us all upset about an audit he just got, and the auditor explained to him that the Internal Revenue Code is not common sense, because our client was trying to explain to him that he was taking these trading deductions because that's just common sense. And the IRS agent said, well, the code is not common sense. And he was right. But basically, when you trade Forex, you're trading cash. It's not considered capital gains. It's ordinary income. The good news for those of you trading Forex, or at least the silver lining, because the good news is on the bad news that you lost money. If you lose money trading Forex, it is ordinary losses. Ordinary losses are deductible against ordinary income, right? It's the same category. When you trade futures, though, you're trading capital assets. 60-40 split, remember? 60% long-term capital, 40% short-term capital. But when there's losses and you're trading futures, those are capital losses. You don't get to deduct those against your income. You only get to deduct those against capital gains. They offset each other, but they don't work against income. The IRS considers income and capital as two separate categories, two different things. Nonetheless, those of you trading foreign exchange can elect to have 1256 treatment. How do you do that? You've got to maintain a logbook and log every single trade, whether it's going to be 1256 or whether it's going to be 988 cash. So you can get with us on that if that's what you want to do for foreign exchange. Now, what about you guys trading stock and stock options? Once again, you are trading capital assets, and so it's going to be considered either a long-term or short-term gain or loss, right? Your losses are capital losses, not deductible against ordinary income, except to the extent of $30,000 a year. Also, wash sales. If you're trading the same stock over and over again, you're going to get hit with wash sales. What's a wash sale? And I'm just going to cover this real quickly because we don't have a lot of stock traders. Most of you are trading futures. There are no wash sales on futures, no wash sales on Forex. This is just for those of you trading stock and stock options. It's not even index, or at least most indexes, broad-based indexes are 1256 contracts. But if you're trading stocks and you create a loss anytime you're trading it and then you buy that stock back, you don't get to enjoy that loss. It's a wash. It's an arcane rule, I know, but what you do get is a new basis in the stock. So you eventually get that loss back. But what happens if you do that towards the end of the year? Yeah, then you're right. Those losses get postponed for an entire year. You don't get to deduct losses on wash sales that happen over the new year, if that's 30 to 60 day window. Usually a 30-day window, sometimes 60 days, But if you generate a loss in any of your stock trading, you might as well consider that loss as creating a new basis, a higher basis in the stock. So once you are profitable, buying or selling the stock back in a future transaction, you'll get that loss back. But technically it's a wash, and it's just a nightmare to keep track of all of this. One solution is to make the mark-to-market election. Mark-to-market eliminates wash sales because all of your positions are marked to the market on the close, on the sound of the bell, New Year's Eve, December 31st. It's impossible to have wash sales, so you no longer have to worry about it. The problem with mark-to-market is there's a major prerequisite. Before you even think about making the mark-to-market election, you have to be a trading business. You either have to be a trader in securities, and good luck with that one. If you have a job, you won't pass muster. If you're not hitting all of the elements as an individual trader in securities, you're jeopardizing your trader in securities status. So what we do is we utilize these entities and let the entity get trader status. Then with that status, we can make the mark-to-market election because the entity is the trading business. And what mark-to-market does is not only eliminate wash sales, but it converts and changes your trading so that no longer is it capital gains and capital losses. Rather, it's ordinary gain and ordinary loss. It doesn't help you on the upside. Do you see that? It does nothing to help you in your winning trades. All it does is protect your losses so that your losses are ordinary losses, completely deductible then against any source of ordinary income. Now, when and how you elect it is you've got very strict rules. If you're an individual and you're wanting to make the mark-to-market election, you need to get that into the IRS this April. That would be effective for 2012. If you're an entity, you get it in on the first tax filing. So we've got some major flexibility in making the election with a business entity. In other words, mark-to-market, before you make the election, your capital gains and capital losses are considered completely separate than ordinary income and ordinary expenses. After you make the mark-to-market election, everything becomes one, and your trading then becomes ordinary gain, ordinary losses, completely deductible against ordinary income. Now, can you see why you don't want to make this election if you're trading futures? Right, because then your income, your trading gains would be ordinary income, 100% short-term capital gain, right? 100% income. So that's why futures traders usually don't make the mark-to-market election, because they would rather have that 60-40 split than the insurance on the downside. Okay, what kind of business can you trade in? You can be a sole proprietorship. There's nothing illegal with that. It's just very problematic. It causes lots of problems. You can trade out of a pass-through or flow-through entity. That's ideal. The LLC, limited partnerships, are perfect. You don't want to use an S-Corp, like we've said, or you can also use a C corporation. Any of these businesses can be a trading business and make that mark-to-market election.
Hey, Trace.
If you do nothing, yes.
Hey, this is Mike. There's a few questions I want to ask before we venture too far, and I know that some of these things you might cover in the next slides, and just say so if so. Let me just ask a few questions before I lose track of them, okay?
Please, thank you. Thank you very much.
Okay. Kojava wants to know, if you trade as a business, do you have to pay higher trading commissions and fees since you're now considered a professional? And again, if you're going to answer this later, just let me know.
Okay. That's something that you'll want to take up with your broker. Many brokers will allow you to have an individual account that is linked to your business trading account. Some brokers will not do that, and they will default you and charge you the higher data fees to trade as a business. And so we don't generally get into recommending brokers or not, but most brokers are willing to work with you. They want to keep your business, and so we've usually been able to find a workaround for trading from the business.
Okay. Robert wants to know, can a trading corporation elect to defer estate tax and get the lower, I'm not sure if I am reading this right, and get the lower going concern valuation like a family farm if maintained as the same business operation for 10 years after death?
Yeah, that's something that we would get into on a individual consultation. For those of you that are on the call, if you would like to take us up on the offer for a free half-hour consultation, type in your phone number to the comment box, and then Raven at our office will contact you to schedule a free half-hour consultation at a time that's convenient for the both of us, and we'll take some of those individual questions. No cost, no obligation. We just need your name and your phone number, and then we'll schedule that at the next convenience. But the caveat there with that particular question is, and it reminds me of the most common question, which is, Trace, can I put my consulting business in the same LLC as my trading business? And of course you can. You can always have multiple activities from one entity. The caveat there is that you just open, when you move your brokerage account out of your name and into an entity, it's now shielded from personal lawsuits and personal creditors because it's no longer your asset. Then if you take that LLC that has that protected brokerage account in it and then go out into the public and start doing consulting, well, now you're opening the door to other kinds of liabilities that may come in with that consulting or farming business. So we would never have a large brokerage account in the same entity as a heart surgeon. I hope that is an obvious example. We would never have an LLC holding a large brokerage account in the same business for an engineer that is designing bridges or any kind of high-risk activity. In other words, Asset Protection 101 works like this. The business that owns everything, like the brokerage account, does nothing. It just does nothing but hold the asset. Now, the business that does everything, that's going out and doing business, doing deals, sometimes riskier than others, sometimes subjecting yourself to a frivolous lawsuit, I know, but the business that does everything owns nothing. How else could Donald Trump file bankruptcy twice and not lose everything? Well, it's very obvious from an asset protection standpoint. The business that files bankruptcy does not bleed into his other businesses. So with that being said, we generally recommend a large brokerage account and a big business to be in two separate entities. You can always set up a second LLC. You can always set up a C Corp, and then you'd have both entities working for you. But you can also start a small brokerage account and a small business together just to save yourself some cost. We don't have a problem with that. It's just that you need to understand this concept of Asset Protection 101, divide and conquer. The business that does everything owns nothing, and the business that owns everything, I'm saying the same thing. I think you get the picture, though.
All right.
Any other questions?
Yeah, there's four more, I hope, real quick ones, and then I'll let you get back on track.
Okay. No problem.
Francis wants to know, when you say futures, he wants clarification that that does include currency futures in that category.
Yes, Francis. Currency futures, commodity futures, all considered 1256 contracts.
Sheldon would like to know, can you do mark-to-market 1 year and then next year do it regular? He's a general partnership.
Good question. No, once you make mark-to-market election, you are pretty much stuck with it. You would have to have IRS approval to get out of it and change your accounting method. And so it would be easiest if you're in that situation to just start another business, start another entity without mark-to-market and try to wait on the IRS to approve you to not have mark-to-market. It's one of those things that's easy to get into, hard to get out of.
Okay. Bob would like to know, can you select mark-to-market for stocks and not for futures, or do you have to elect it as a blanket for everything on your trading activity?
Very good. That allows me to brag about our mark-to-market election resolution. The code allows you to make mark-to-market for stocks and stock options only, and to carve out and accept and not make the mark-to-market for futures. And so that's a very good question, and that, because that's so popular, by default, that's how our resolution is worded. You make the mark-to-market election for stock and stock options only, and under the 475H1 something something, you exclude it. It is not made for futures. So yes, Mark, that is absolutely possible, and in fact, that's how we do ours.
All right, last question, then we'll move on. Going back to something that you said earlier about single-member LLC, did I hear you correctly to say that single-member LLC does not have asset protection? Like you can, an outside party can still sue you as an individual and have access to the assets inside of a single-member LLC?
That is correct. That's the short answer. The long answer is it's correct because an LLC provides you even better asset protection than a corporation, because how it works is if you are an LLC and you own the LLC and somebody sues you, they don't get the LLC's assets, but what about your interest in the LLC? Can they take that? And the answer is no if you have another partner, because what the court looks at, and this is a Florida case example, and in Florida there was a single-member LLC. The owner got sued and the court said, look, there's no other partners here to protect. So why should we protect this charging order from no other partner? So that's the rationale behind the rule that the courts are using. And so it totally changes the precedent for a single-member LLCs. But when you have another partner, then the court says, look, we're not just going to let somebody come in and take your interest in a partnership and dilute or destroy the other partner's interest in the partnership. And I'm saying partnership because multi-member LLCs are taxed by default as partnerships. And so it's just one of those things that that's the rationale. That's the long answer. Sorry,
okay. Okay, and I
find it fascinating, so I ramble on.
All right, one follow-up question. If someone,
what's that?
One follow-up question.
Oh, no problem.
Someone wants to change the type of corporation, like from single-member to multi-member, or from S corp to LLC or whatever. Can they do that, or do they have to start over?
They can do that. You would want to work with a tax advisor to add a partner, because that partner needs to provide funding into the LLC. So for instance, if your LLC is worth $50,000 and you wanted to add a family member at 1%, then they would need to pay the LLC $500 in exchange for that 1%. But then we have a money trail. So if anybody's ever audited, we have got a money trail showing that yes, indeed, this LLC is now a multi-member LLC, and you would probably want to do a change of accounting method too, because Single-member LLCs are taxed as sole proprietorships. Multi-member LLCs are taxed as partnerships. And so we would want to make sure that all of that is very clear and spelled out to the IRS and done at the most convenient time. And we can help you with that. If you want to plug in your phone number, we could talk about that in a consultation as well.
Okay. Yeah, I see a bunch of people putting their phone numbers in. All right, so I'll let you get back to the presentation, and then we'll take questions at the end. Thanks.
Okay. Thanks, Mike. I appreciate you staying on top of those questions for me. It's hard enough to do get through these slides and talk at the same time to an audience that I'm trying to get the feedback from the visual. So thank you. Okay, we left off here. You're classified by the IRS on how you trade if you do nothing to improve your tax classification with the IRS. And even though you trade substantially, they will want to default you into a classification like a hyperactive investor. What you want to do is make sure that you're not classified as an investor. Why? Because then you're subjected to the $3,000 loss rule, wash sales. You don't get to deduct what you can deduct as a trader. And so you want to take certain steps to get out of the classification of being just an investor. Now, there are two tax systems in this country, one for individuals and one for business. Often what we run into are business owners that have run sole proprietorships for years successfully, no problems. But if you try to do that as a trading business, you may end up in the Atlantic Ocean when you're trying to get into the promised land. There are two tax systems in this country, each represented by a river going along the Manhattan. And I've got a trivia question. Can anybody tell me the name of the real river that one runs on the west side, and which is, and then on the east side we've got a tidal estuary. It's not a river at all. It goes right back into the Atlantic Ocean. Thank you, Billy. Steve, you're right. That's the Hudson River. The Hudson River was discovered by Henry Hudson in the 15th century. He worked for the Dutch West Indies Corporation. Corporations have been around longer than this country has been around. We inherited corporate law from the English and brought it into our codes. So don't try to get corporate treatment as a sole proprietor, because you may end up back in the Atlantic Ocean because you may not fit the IRS's definition of trader in securities. And so it's very problematic, and I just use this illustration to show how easy it is to think that you're a trading business, but in all actuality you're a sole proprietor. And like I said, the difficulty with that is maintaining that trader status in the first place. And if you don't, then you're going to lose out on all your deductions, and your income is nowhere on Schedule C, and that's always been a red flag for the IRS. Getting a Schedule C with all these expenses and not a matching amount of income, but you take yourself out of that realm as soon as you join corporate America and incorporate and formalize a business and start floating down the Hudson River. Okay, real quickly, you don't need to become an accountant, but you need to understand that our tax system in this country is basically that you are taxed on your taxable income. What's taxable income? Taxable income is your net income after a few deductions. As an individual, you get a standard deduction. You get a few things that you can deduct, like the interest on your home, charitable contributions, but that's about it. But that is what you're taxed on, is that taxable income. What is income? According to the United States Supreme Court, anytime you get control over income, anytime you have control over the dollar amounts coming into your accounts, bank accounts, brokerage account, the IRS is going to assume that that is income to you because you have control over it. So what we're going to do today is attack income tax by splitting your income. We're going to attack income tax by attacking income itself. We're going to split income. We're going to lower your net taxable income. And I'm not talking about making less money. I'm talking about making more money but having less taxable money. And then lastly, my favorite, we're going to change your taxable income into excluded income. So how do we split or shift our income? According to the book, How to Pay Zero Taxes, tax attorney CPA Jeff Schnepper says, you can reduce your tax by attacking the progressivity of our tax rates, by allocating family income to different family members and different entities. What's he talking about there? He's talking about splitting the income and attacking the progressivity of our tax brackets. It's all about making more money, but the more money you make, the more taxes you pay, not just because it's a percentage, but because it's a higher percentage. The more income you make, the higher the percentage. Here's our 2010 tax brackets. I didn't have them for 2011 at the time, but you notice on the far right you've got corporations. Corporations can make $50,000 and still be in a 15% tax bracket. Individuals, once again, the more money you make, the higher bracket you creep into. So these are the brackets that we're going to play. How do we split the income? Well, you've got your job. You've got income from your job. But you've already got another source of income that you can split automatically. You've got your trading income. And remember, any income coming into you is going to be subjected to all kinds of tax. So how do we split that? Well, we just take your trading income, and instead of having that being made by you directly, we split it and have it made by the trading business. LLC, corporation, either way, the entity is going to be the taxpayer. It's no longer going to be income directly made by you. It's going to be made by the trading business. Now, you're going to have a relationship with your trading business. You'll be the only one trading on the account. You'll be the only one signing the corporate checkbook, but it will be the company that's making the income. Why do we do this? Well, let me ask you a question. Would you rather have one taxpayer making $100,000 taxed at 35%, or two taxpayers making $50,000 each taxed at 15%? Absolutely. Two taxpayers making $50,000 taxed at 15%. All we need is that business entity set up. So now, instead of having your trading income go on top of your income from your job, you've got the trading income starting at zero. And so you're not paying 35% tax on your trading. You're paying it at zero to 15%, as long as that corporation, once again, is making less than $50,000 net after all of those deductions. So once again, we're playing the brackets and just splitting the income amongst those different taxpayers. How do we do that? Well, this is an opportunity for you to sit down with myself, and we'll discuss these exact strategies and how they fit into your family situation. But remember, we're splitting the income and allocating it amongst different family members and different entities. So we can take the income and put it into the corp or the LLC. We can also have the children making some income. Why do we do that? Well, we've had clients paying their children for years. Remember, this is not a kiddie tax. This is earned income. But once you have a trading business, you can hire your children. So instead of paying them an allowance for movie tickets and school clothes, that is not deductible. But instead of paying them an allowance, you can have them work for the business. As long as they're over 7 years old, they can work for the family business and be paid a reasonable salary. And with that salary, sure, it will be income to them, but it'll be deductible from the business, and you can actually pay your child $10,000 a year and still not have them recognize any income on their side. How? Well, remember, the child has their standard deduction that's worth at least $5,600, and if you want to pay your child more than $5,600 a year, then have them put those funds into an IRA. The child can also fund their IRAs with $5,000 a year. So yes, we've had clients for years using this strategy, and using the business is just an elaborate an enhancement to this strategy of splitting income amongst different family members and different entities. And once again, we can help you do that in the consultation. Free 30-minute consultation is all that says, but let's move on and talk about how to lower your taxable income. Same book, How to Pay Zero Taxes. Mr. Schnepper says you can arrange your activities so that certain expenses that you would make anyway will now be allowed as deductions. Deductions that reduce both your gross income and your taxable income. What does he mean by that? Well, here's some things you should understand. For every dollar you write off as a deduction, you save some percentage as cash flow, cash coming into your account, not having to go to the IRS this April, but staying in your account to buy more inventory, to buy more stocks, options, to trade with. Many expenses that unless you trade as a business you cannot deduct, and a trader's largest expense is taxes, whether you make or lose money trading, and that refers to the mark-to-market. Also, some interesting things to know, there are 2 tax codes in this country. It shouldn't surprise you, but there's one code for business and one code for individuals. Did you know that General Electric made $5 billion last year and will pay 0 tax? If they have it their way, they will get a tax refund on some of the credits that they're trying to achieve. We're doing nothing different than that. We're using the business tax code at the family level. We're now leveling the playing field. There's nothing to stop you guys from starting your own business, and a home-based business is the biggest tax break left in this country. So you trade out of your home, now you get the home office deduction. Now, General Electric's tax filing was over 7,000 pages long. So obviously they paid thousands of dollars in tax preparation, but it saved them millions and millions of dollars in tax. But we're leveling the playing field by allowing you guys to be in business for yourself and use the same rules that the major players are using. What does the IRS consider a business to be? There's an economic performance that needs to be met. There's 9 other factors, but when you incorporate, you meet all of those. Here's the bottom line difference. Here's the difference between individuals and businesses. Individuals make money, and then they pay taxes on the money made, and then they're able to spend whatever's left coming from that paycheck that taxes are already taken out. Businesses, on the other hand, they make money, they spend money, and then they're taxed on what is left. Do you see the difference? It's basically a difference on deducting expenses from your net taxable income. Here's an example. You've got trading income. It's now not coming in, it's no longer coming into your name, it's coming into the company name. But now the company, in addition to splitting the income and getting you into a lower bracket, it's also got over 200 ways to spend that money. Not to say that we are asking you to increase your expenses. Rather, take your existing expenses and get a tax deduction for them. You need to deduct your trading education. It's not investing education, it's a trading expense. And by the way, we can go back and get 12 to 15 months of pre-incorporation expenses. So if you have spent a substantial amount of money learning how to trade in 2011, don't bother trying to deduct it off your individual return where you'll be reduced on what you can deduct according to a percentage of your AGI, etc., etc. Rather, let's take it as a pre-incorporation expense. Let's get you incorporated now and take it as a pre-incorporation expense. We can grab all of 2011 expenses and deduct them right now. Some obvious ones, of course, the business now can deduct expenses like office supplies, home office deduction. That is not a red flag. The IRS has now been saying for years now, please advise your clients on taking the home office deduction now that technology is allowing so many Americans to work out of their home. This was published to the accounting community 2 years ago. So it's not a red flag to take a home office deduction. A business needs an office. It just so happens to be in your home. But if it is in your home, then we get to deduct a percentage of your utilities, of your alarm system, outside of the building as well, sprinkler repair, roof repair, cleaning supplies, replacing the carpeting. All of those things now are deductible. And then, of course, your data fees, your phone. And here's a good one, medical, dental, and vision expenses. If you are paying out a lot of medical and dental and vision expenses, a C corporation is what you will want to look at, because a C corporation is the only entity that can completely deduct medical, dental, and vision expenses for its key employees. For the employees, it's just a business perk that has been around for decades. So if you have a lot of medical, dental, and vision expenses, we will definitely talk about that in your consultation, because if you want to be able to deduct that and take it off of your gross income, reducing your net taxable income, then a C corporation is for you. Okay, once again, it's all about keeping that corporation. You notice that that corporation made $100,000, but it netted $50,000. Why? Oh, that puts us right into that 15% tax bracket. 0 to 50,000. Corporations pay 15%. 50 to 75,000, well, now you're in a higher 25% bracket. The current campaign on both sides is talking about lowering corporate tax brackets to 25, 28% maximum, because after the 25%, they do start to catch up with individuals. The highest corporate tax bracket now is 35%. It's after deductions, but we're only going to let your corporation make enough money to spend, give or take $50,000, and we can control that by having it just own a small, medium, or certain percentage of your trading LLC. And I'll show you what I mean with an illustration. Here's some things that we deduct. This comes right out of our pro forma that we walk you through when you set up a corporation with us. We deduct automobile expenses, organizational expenses, equipment purchased from the shareholder. That's you guys, right? You're using a computer, let's write that off. On the bottom there, you'll see medical reimbursement plan. We'll actually put that into your projection and provide you a pro forma. Here's some obvious ones: dues and subscriptions, educational expenses, and then there's your home office deduction, office equipment purchase. Section 179 allows you to deduct your computer in 1 year. You don't have to amortize it under Section 179. And then in the bottom there, travel, entertainment, hotels, meals, those things now become deductible. Once again, the key here, notice telephone, internet is on there as well. The key here is not to increase your expenses. We want you guys to be as profitable as you do, but we also recognize that there are some expenses. It costs money to live in this society, right? So let's make as many of those expenses as deductible as possible. Once again, we can help you with that under a free consultation. So we look forward to working with you guys individually as well. Okay, lastly, we're going to talk about changing taxable income into excluded income. Same book, How to Pay Zero Taxes. Mr. Schnepper says the most important thing you can do as a taxpayer to reduce your taxes to zero is convert your taxable income into excluded income, not even included in the gross income. Picture, it's the best kind of income. Okay, what do I mean by that? Is that even legal? How can you change income from being taxed to excluded? Well, remember, that's exactly what we do when we make the mark-to-market election. We're changing the nature of the capital gains to be ordinary gains. So it's no different with excluded income. In fact, you may have already enjoyed some excluded income. If you've ever sold your home, that is not income to you. It's excluded. If you've ever received a life insurance death benefit, that is not income to you. And of course, my favorite, any benefit that your trading business provides you, like medical reimbursements, like a small amount of life insurance, like cafeteria plans, those are all benefits that the company can provide and pay for you that is not income to you. And of course, my all-time favorite, 401k contributions, not income to you. How does that work? Well, once again, let's go back and remember, we now got the trading income coming into the business, and we've got 200 ways to spend that money coming into the business. One way to spend the money and to take a deduction is to pay you a salary. But remember, that salary, 100% of it can go into a 401k. That's a deduction to the business and not income to you. Perfect. So here's an example. You've got $50,000 of trading company income coming into the trading company. You want to take some money out as a salary, so you take $20,000 out, but you decide to maximize your 401k and put $16,500 into the 401k. That's actually last year's figure. You can actually do $17,500, but if you're over 50, you can do $22,000. But any amount that you put into the 401k, it's not income to you. So even though you took the salary out and put it into the 401k, not income to you, and on top of that, a deduction from the business. So you take any amount of trading income and you flow it into your trading business. You take a salary out, but 100% of your salary can go into the 401k. Up to the year's limitations, $17,500 if you're under 50, $23,000 this year if you're over 50. And then notice also in the lower left-hand corner, the corporation can also match your salary. It can also match 25% of your salary. So you could technically fund your 401k with up to $40,000, $50,000 each. Where does it go? It goes into a 401k trading account. And with that 401k, you go to the broker, and we help you with this. We help you set up the 401k trust trading account. Any broker of your choice. Now, instead of being taxed, you are tax-free. You're tax-free on your profit. Technically, it's tax-deferred, but I think you see what I mean. This is our example of tax-free trading. Now, that sounds great, Trace, but I don't want to put money away until I'm retired. That's too far away. Realize that you can access your 401k through loans at any time. $1,000 minimum, $50,000 maximum. You can only borrow out of your 401k 50% up to $50,000 under a 5-year note. If you're using the loan to purchase your primary residence, we can stretch that loan out to 15 years. But the bottom line is that even though this is a retirement account, it's going to grow a lot faster than all your other accounts because it's tax deferred, and you have access to it through loans. So in other words, it's just simply another trading account, and it's always going to outpace your LLC and the corporation. It's very easy to operate. There's no minutes. There's no meetings. There's not even a tax return. Not even a tax return on a 401k under $500,000 of assets. Once you get to that amount, then sure, we'll have a 5,500 tax return. It's a very simple return, but it's basically taking the net profitability of the 401k and notifying the IRS that that's what your account is at. And if you have a 401k with us, you can designate some of it to be a Roth 401k and some of it to be traditional 401k. And yes, you can trade futures, you can trade short out of the 401k, because we'll approach your broker with a trust account application and help you set up that 401k trading account in the broker of your choice. So, to summarize, today we have attacked income tax by attacking income itself. We have split your trading income and taken it off of your poor shoulders and put it into a business. Now that business gets over 200 business deductions, including 401k contributions. Before Traders Accounting, here you are trading as an individual getting taxed to death. After Traders Accounting, now we're trading tax-free. Before Traders Accounting, we are subjecting that brokerage account to personal lawsuits. 1 out of 5 of us on this call will be sued. There are over 100 people on this call. 20 of us will be sued in our lifetimes. If you are sued, the first thing that the plaintiff's attorney will do is an asset search, looking for assets in your name. If you have a trading account and it's in an LLC or 401k or both, those are protected. I have seen people go through bankruptcy with their 401ks completely untouched. So here you are after Traders Accounting, trading out of the 401k, trading out of the LLC. Now here's a close-up of that picture. Remember, I said that trading income is unearned income. The LLC will pass the trading income through as such, as unearned income. So it comes out to you, no self-employment tax, no Social Security, no FICA, no Medicare, no Medicaid. That may be sufficient for some of you. Just that alone, just the trading LLC. However, if you have a large amount of income and a lot of corporate deductions and even a lot of medical expenses, then we would have your LLC owned and managed by a corporation. And then ultimately that corporation can begin funding a 401k. So that's kind of a close-up of where you guys are headed when you have the ultimate tax-free structure. But I encourage you to start with an LLC, add a corporation, add a 401k once you're profitable, or if you have an existing IRA and want to fund a 401k with it, perfect. We can do a IRA rollover into a 401k, and if you're wondering, yes, once the IRA is in a 401k, then you can borrow that 50% out under that note. We do that all the time here. Okay.
All right. There's a bunch of questions. So a couple things. First, sure. Trace had mentioned to everyone in the audience that if you want someone from Traders Accounting to contact you for their 30-minute free consultation, type in your name and phone number. So go ahead and do that now if you want. Second, if you have questions, type them in. We'll do the best we can to get to everybody's questions. So I'm going to just start reading off questions, Trace, and we'll try
Yes, please. Thank you, Mike.
Try to just get through as many as we can. So backing up to where we last left off, High Five wants to know, if I'm interpreting this right, he wants to know if the asset protection still is applicable if the second partner is only a 1% partner.
Yes. Yep. Absolutely.
Okay.
Absolutely have asset protection. That's what's, yeah. Yep, you do. No question.
Guillermo, I hope I'm not butchering that too bad, wants to know if he opens an account at a introducing broker in Canada, because he lives in Canada, what's going to be different for taxes and LLC in Canada. So that's actually a good question. I see several questions from people that are outside of the United States. Does traders accounting do anything outside the States, or is this only applicable to the U.S.?
Good question. We have several clients overseas, but they're all American citizens, and we specialize in American taxation, which is very similar to Canada. We have some retail products that gear towards the Canadians. We do not do anything offshore. We completely use domestic entities. If you need the offshore structuring, the international structuring, and you're an American citizen, you have to report that. America is the only country in the world that taxes its citizenry regardless of where they live and where they make their money, but nonetheless it is required, and so you really have to be careful and start out by using these American entities. And those of you that are overseas, if you're American citizens, we can still help you, and because you're overseas, you do get substantial tax breaks. You don't have to pay, for instance, income on your first $90-something thousand of income, and we can use a Nevada corporation LLC structure, for instance, but unfortunately that's about the extent of our services to people residing outside of the states. We have a lot of military clients, a lot of people that travel overseas and live overseas, and we certainly help them structure and pay and comply with their American tax liabilities. But other than that, we do not. We don't go into Canada or other foreign countries. Not this time.
All right. Matt V wants to know what filing status is appropriate if he has a full-time W-2 job separate from trading, but he is a profitable trader.
Well, congratulations first and foremost, right? Trading is difficult enough, but I love it when you guys are making money. We have never seen, Matt, we've never seen a tax court case that allows a person to maintain their trader status, even though they claimed it. When it got to court, the court shot it down and said, no, you had a full-time job or even a part-time job. So it just doesn't work. However, that's where the entity comes in, because there's nothing that prohibits you as an employee from having a business on the side. And once the business is in business and it then gets the trader status at the company level, it doesn't matter that the company owners have other jobs. It's the company itself that gets the trader status. And so that's why we are so adamant about using entities, and we really have developed an entity department. We don't just do tax and bookkeeping, but we have a full-fledged department geared to setting up LLCs, corporations, 401ks. For that very same reason, we have plenty that we have doctors, lawyers that, well, it doesn't matter what the day job is, but they're trading out of the entity, and it's the entity itself that gets the trader status. Remember, once you set up the entity, that's a recognized person. That's a recognized entity. It's a recognized taxpayer. So it has its own identity in tax court, in any court in this country. Completely separate and distinct entity. So, yeah.
All right. DW would like to know, does your trading business need to be profitable in order to take the home office deduction?
No. In fact, your trading business does not need to be profitable. You may be confusing the issue with hobby loss rules that apply to individuals. And so if you're claiming a trading business as a sole proprietor, that's where it becomes problematic. But once you've got the entity, remember you're in the same ballpark as Yahoo and Google that went decades without showing a profit, right? Their stocks did great, but these companies, they can go years without being profitable. Not a problem. And the nice thing about the LLC, DW, is that if you don't have a trading profit, if you're flat or at a loss, the LLC is going to take the flat trading and the expenses and then throw a negative number on your 1040. Because the LLC does not pay a tax, it's a flow-through entity, so all of the expenses flow through to you. So now you've got the LLC losing money, creating a negative number, a loss that then shows up on your 1040 that offsets your other income.
Okay. And before I read any more questions, did you happen to have a slide that has contact info on it that you can throw up while we're reading the rest of these?
Yeah, let me go back to that.
All right, so while you're doing that, the next question from Trader398. He says, Trace, you seem to imply that earned income is a bad thing for full-time traders. I'd like to believe that earned income is a good thing for traders because although they have to pay self-employment tax, they can now contribute to a retirement account, which otherwise would not be possible. So finally, we get to the question, which is, can you explain why earned income is bad for traders other than self-employment taxes?
Good question. I'm glad I had a chance to clarify that, because unearned income is, people just need to realize that there are different kinds of income, and when you trade in the market, it is unearned income. That's a good thing. That avoids self-employment tax. The LLC will pass that unearned income on to you and still avoid that self-employment tax. Now, if and you're right, it's not a bad thing to convert that from unearned to earned income so that you can contribute to the 401k. And this slide kind of illustrates that. We're taking the 401k out of the corporation because we need to have earned income to fund the 401k. And so here we're kind of getting the best of both worlds, because here we've got money going into the corp, converting it then into corporate income, and then from the corporation, the only way to get it out essentially the only way to get money out of your C corporation other than paying for all of your expenses is to pay yourself a salary. And if you've got a 401k in your back pocket, that is a huge, huge benefit. You can put 100% of that salary into the 401k up to those limitations. 17,000 under 50, 22,000 if you're over 50. That's for both you and your spouse. And on top of that, the company can turn around and match 25% of that salary and put even more money into the 401k. And so, yeah, I was trying to basically explain the difference between earned income and unearned income and the advantages and disadvantages of each. The advantage of unearned income, obviously, is that it avoids that self-employment tax. The disadvantage of unearned income is that you can't put that into a 401k without converting it to earned income. And so we generally will structure it so that the corporation that throws off earned income by its very nature owns and manages the LLC. That way we can control how much money goes into the corporation. We never have to worry about a double tax, and we can pay out a salary deferral into the 401k. You could have a 401k off of the LLC, but once again, how do you then convert that unearned income to earned income? Well, in partnership parlance, you pay yourself what's called a guaranteed payment and pay the self-employment tax before you put it into the 401k. That's not as good of a structure of having the LLC owned by a C Corp that then puts it into the 401k without having to pay that self-employment tax. So this structure right here that you're looking at, it completely avoids that self-employment tax, but you could have a 401k off of the LLC. We do that all the time to save expenses, but then you have to realize that to fund more money into the 401k, you have to take your unearned trading income, convert it to earned income, pay Social Security tax, and then put it into the 401k. Whereas if you had a corporation, you could avoid that self-employment tax. So
Okay.
I did not mean to imply that one was better than another. I just wanted to kind of explain what happens to trading income.
Okay. I know there's about 130 questions, so we'll just, we won't be able to get to all of them. Obviously, we'll go as quickly as we can. All right. David wants to know, can you also trade in a Roth or traditional IRA if you use a self-directed trust?
Can you also trade in a Roth or 401k if you trade in a self-directed trust? Yeah, trusts are one of those things that you can use for just about anything, but taxes on trusts are worse than individuals. It's a horrible tax bracket. You don't want to be using a trust to trade out of, because if it's a living trust, for instance, you have no asset protection and no tax planning. This may be better suited for an individual consultation, but to be brief, you could set it up so that would work, but I would need to see the particulars and would want to see how that trust was being taxed.
All right. David would like to know if he has an LLC and the flow profit towards the C Corp, does he expense all trading operations at the C Corp and nothing at the LLC?
Generally speaking, yes, David, because it's easier on your bookkeeping. It's easier on your bookkeeper if you use us to have one entity paying all the expenses. And it's a little bit different. You need to move money out of the LLC and into the Corp, but you can do that once a year. You don't need to move money every single month. You can basically move money around at the end of the year under accrual method of accounting, and mark-to-market works the same as accrual. But David, it's going to make your life easier if you have all of your expenses coming out of one entity instead of two, and then that way you would have your LLC making all the money and the corporation spending the money, and then you would only have to really reconcile that corporate account, because remember, we need money going into the corporation to cover medical costs. That's the only entity that can cover medical, dental, and vision expenses. So since we've got to move money there to cover those expenses, it would make your life easier if all of your expenses were coming out of one account instead of spread out over two. That way we just have the LLC with the trading and not a lot of banking activity, and the banking activity and no trading being done from the corporate side.
Okay. And I see several people asking for your email address or phone number, and also the guys that have more complicated questions, I would suggest you type in your phone number so that you can get a phone call.
To that contact page.
Okay, John.
The arrow's probably on your screen.
John would like to know, does a trader have to list every transaction and trade made during the year, or can you take only the net gain loss for each instrument? And John did not specify if he's talking about futures or equities.
Well, we had a situation, and we had a Schedule D come in about 40 pages long, so our tax department contacted the IRS and said, do you want all 40 pages? And the IRS said, no, just give us the totals, but keep the 40 pages of transactions in your permanent records. So we're kind of using that as a precedent. But like you said, Mike, each instrument has different tax consequences, and so if you're trading amongst different instruments, somewhere along the line we would need to break those out. And I guess I should put a plug in for our bookkeeping department. If you guys want to have a professional bookkeeper, whether you got the LLC with us or not, or whether you're trading individually, we can do your books. I'll offer it to today's attendance at $75 a month. That's normally the price that you pay for a whole year, but if you want to try us for 3 months, we could have you guys give us a trial run for $75 a month with a 3-month deposit. That way you could have a professional bookkeeper reconcile your accounts and generate a monthly profit and loss for you. And then off of that 3-month experience, you could then decide if that's something that you think you want to take on yourself and do yourself to save some cost, or if you want to just continue to have us do your bookkeeping, we would love to do it. But that's my plug for the bookkeepers.
All right. Excuse me. Jerry would like to know, is paying child support considered, wow, I'm not understanding the question. Is paying child support considered a creditor? That's what the question says.
Yeah, child support, that's a whole different level of of creditor. So we
all right,
we
John,
want to be very specific. Yeah.
Yeah, I'll just move on. That's complicated. All right, John says, can an LLC be set up inside of a, or I think what he means is, can you set up a LLC as part of your 401k, or can the 401k be inside the LLC?
That's a good question, and it often comes up. It's hard for most people to understand that the 401k is an employer-employee benefit, and you are basically the employee and the employer. So what you really need to do is become schizophrenic to understand some of these legal and tax concepts, because your trading business, whether that's an LLC or a corporation, it actually sponsors a 401k. But the 401k is an entity in and of itself. It's a trust by legal definition. It has its own tax ID number, and it's completely separate and different. It's not inside of the LLC, nor is the LLC inside the 401k, but the sponsoring business, and I prefer the C Corp to sponsor it, but it can be done with an LLC. But whatever that sponsoring business is, it sets it up for its employees, which is basically you and your spouse, right? But it's completely separate, and it's highly regulated by the Department of Labor and the IRS. But those guys have given us a great vehicle to trade out of.
Okay. Billy would like to know, if he chooses mark-to-market and he loses $10,000 worth of trading losses, can that $10,000 be commingled with a regular job ordinary income and ultimately reduce his taxable income?
Yes. Yes. Mark-to-market, $10,000 of losses under a mark-to-market regime, under a mark-to-market election, converts those losses, and they're no longer capital losses. They're considered ordinary losses. It's even a different tax form that you file. They're ordinary losses, completely deductible against ordinary income. And remember, if that's done in the LLC passes those losses to your 1040. Now you've got a negative $10,000 number that will offset any and all sources of income that show up on that 1040. So yeah, that's one way to describe it, is it commingles and it deducts against all sources of income.
Okay. Mike would like to know, he's about to hit the magic number of age 65. He has a Roth IRA, but it has not been in place for 5 years yet. Can he still trade the account and draw tax-free income?
It's not quite hit that 5-year mark. I would wait and make sure that you've got that 5-year mark hit, and ask us. There may be some more specific details that I would need from him to. I hate to give a definitive answer to a specific question like that without knowing all of the facts.
Sure. All right, Tim.
But congratulations on the big birthday.
Yeah. All right, Tim says once he incorporates, can he put some money into an existing Roth IRA of his and or his wife's?
He's asking, can he do it after he incorporates?
Right. I guess that's the question. Yeah.
Yeah. No problem at all. You can continue the Roths and the IRAs while you're doing this business. But even better, if you're considering a C Corp, why not have a Roth 401k? That way you got it in a 401k so that if you needed to borrow the money, for instance, you'd have access to it. Because when you borrow from your 401k, it's not a hardship. It is technically a loan. There's no tax that is due when you borrow from a 401k and you set up a 5-year amortization and you pay on that on time. You pay it quarterly. So yeah, you can do the Roth and the IRAs as well forever, as long as you're not getting phased out because of your levels of income.
Okay. Sal wants to know, what are the requirements to qualify for trader or professional trader status, and in particular anything regarding LLC requirements?
Well, Sal, when the LLC is getting trader status, it's a much easier hurdle because the LLC doesn't have a part-time job. But if you're finding that you have periods where there's not a lot of trading activity, not a lot of actual trades, then what you'll want to do is maintain a trading log. Because by legal analogy, we have found in our research that the IRS has indicated that if somebody is devoting 500 hours to the business, that's a legitimate business. 500 hours a year, that works out to be about 10 hours a week. So because the IRS is looking for continuity and regularity, if there's a time that you're not trading a lot, then just maintain that in your trading log that you were looking for setups, didn't find them. But trader and securities is one of those things that's never defined. It's coming to us in the form of factors by case law, by tax court cases, and one of the biggest underlying elements is your intent. And so when you set up an LLC, you're clearly establishing and proving your intent to trade. It's all over the operating agreement. It's in your resolutions that you are a trader. So it's much easier to get that status and maintain it. But we do encourage people to maintain the trading activity and maintain their record keeping. It does make you a better trader as well.
All right, Tim would like to know, if he incorporates today, does it have any favorable effect on his 2011 income? So last year.
Yeah, Tim, it does in the form of pre-incorporation expenses. The IRS has always allowed businesses and recognized the fact that businesses have expenses before the business has a bank account. Now the question becomes, how far back can we go? And our office is comfortable with going back 12 to 15 months to pick up all of your pre-incorporation expenses. So even though you incorporate today, we could take your educational expenses alone as pre-incorporation expenses. And the reason we would want to do it there and not on your individual tax return is to save you several thousands of dollars, really, because when you try to deduct investor education, you'll find that you're limited to a certain percentage of your adjusted gross income, and you do not have that as a pre-incorporation expense. You just claim it as a startup cost to getting your trading business going. You needed to educate yourself on the trading business. That's not a problem at all. It's not a red flag. It's just a pre-incorporation expense. So yeah, we can go back in 2011 and grab those expenses. You won't be able to deduct them this April, but they would be deducted from next April, and they would not have any kind of limitation that you would with an individual.
Okay. High Five would like to know, how can he use his 401k from his current day job in order to trade with?
High Five, even though that's legally allowed, it's your 401k. Most companies have a policy that they only want their 401ks invested with their 401k advisor, and so you're going to have to wait until you resign or retire. Then that 401k will be completely yours, and they will ask you if you're going to, what you're going to do with it, and you would tell them you're going to roll it over to an IRA, and then that IRA can go out and trade. It does have some limits. You can't sell short, etc. But from an IRA, we could then roll it into a new 401k with your new employer, and your new employer is obviously your very own corporation, your very own company. And so right now you don't have a lot of access to it, but when you resign, you can access it. Now, if any part of that 401k is from a previous employer, you should be able to take that out as an IRA rollover and roll it into a 401k or roll it into an IRA.
All right.
But for now, you're stuck.
GM would like to know if he has a two-member LLC and one member is a non-U.S. citizen that lives outside the USA. Trying to translate as we go. What is the tax implications of the non-U.S. citizen?
That non-U.S. citizen would be subjected to tax and probably automatic withholding that they just increased to 30%. We could, if you wanted to dilute that member down to a lower percentage, but that person is technically responsible for their percentage of the LLC's profits. So if they own 50% of the LLC and the LLC makes $100,000, then they would pay tax on $50,000, even if the LLC keeps the money in the LLC trading account. That's the beautiful thing about partnership and the taxation of LLCs as multi-members. You can keep your money in your trading account and just let the owners pay the tax on it. You never have to worry about a double tax. You simply report what the LLC made on a 1065. The 1065 will file a K-1 that goes to each owner's 1040, and whatever percentage you own of the LLC, that's your tax liability, regardless of whether you just receive the profits or not. So as an LLC owner, that's perfect for you because you can continue to trade and keep all of the money, all of the profits too, can stay in the LLC, and we can simply adjust everyone's capital accounts. Say, look, we made $100,000 this year. Nobody's going to get anything. We're going to keep it in the LLC, but you owe this much tax, you owe this much tax, and that's how that works. So it's very convenient. That's how Warren Buffett got started.
Okay. I'm going to cut the questions off once we get through the ones that are on my screen, which is about 5 or 6 more. So if we didn't get to your question after those 5 or 6, then please, you have 2 options. You can either stick your phone number in here and Traders Accounting will call you, or you can call them on your screen to get the phone number. All right. For those of you asking about whether or not the webinar is recorded, yes, always. and it'll be posted sometime tomorrow. John wants to know, what are the typical fees for incorporating and filing annual taxes?
Okay. Thanks, John, for letting us plug ourselves again. And thank you, Mike, for taking these questions. This literally could go on all night long. It just seems to open up a can of worms when we start talking about these things, but they're very important, and so we do look forward to answering your questions under a confidential consultation. But our typical fees, we have a LegalZoom type of product, which is about half as much as LegalZoom. If you go to LegalZoom and get a corporation or LLC set up, by the time you get your bylaws and your operating agreement, you're usually $600 to $800 into it, right? We have a basic LLC that we set up one-time fee only for $595, but for those of you attending tonight, we will discount it to $395. $395, Raven, for everybody that gets a consultation. $395 plus the state filing fee. And then, John, you're looking at an extra tax return every year. It's not a big deal. Any CPA in town can do a 1065. If you want us to do it, we'd be happy to do it. But a 1065 is simply an LLC return that ties into your 1040. And once again, the analogy is to GE. General Electric paid zero tax on $5 billion of income. How they did that was through these exact same strategies that we've been talking about. Splitting income, deferring it, deducting it, all of the things we talked about. GE is a master at those things on a global scale. But they do have to pay more in tax preparation. Their tax return itself was 7,000 pages long. So you do have a little bit extra tax filing, but it's going to be a fraction of the thousands that you save every year for doing it this way. Our typical client saves about $8,500 every single year because they've got over $20,000 of deductions now that they're taking that they weren't before. So
okay,
usually the entities are about $595, but we can discount them to $395 each.
All right, KJ would like to know, are trading commissions, exchange fees, data fees, platform fees, etc., all deductible as business expenses when you're trading?
Yes, all of those things are absolutely deductible.
Right. Joe would like to know, and I hope I pronounce this right, can a KEOG plan be used instead of a 401k?
KEOs, yeah, we can use a KEO. In fact, we can take a KEO and roll it into a 401k. It's a qualified account. If you're happy with where the KEO is at, just continue to use it. If you would prefer a 401k, we'd be happy to show you how to roll it into a 401k as well.
Daniel would like to know, I'm not sure if he was referring to something that we were talking about before or not, but the exact question is, can the corporation pay a bonus?
Can the corporation pay a bonus? Absolutely, it can pay a bonus. You got to realize that all of the money you put into these entities, you've already paid tax on. So you can take the money out tax-free because you've already paid tax. Now, with a corporation, you take it out as a repayment of the loan. With an LLC, it just comes out as a capital account. So there's a little bit difference there between taking it out of a corp and taking it out of an LLC. But you can always take the money out. But realize that when that capital starts to generate profits, then it's income to the corporation. Or if it's an LLC, it's an income to the owners. If you're in a corporate structure and you pay yourself a bonus, the corporation gets to deduct it. It's income to you as the shareholder, owner, employee, what have you. And so, yeah, you can always do that, but there may be better uses of that bonus. It could go into a 401k, for instance. If you haven't set up the structure yet, an LLC may work better, because then the bonus would automatically happen by virtue of just it being an LLC, and it would flow through to you automatically net after all of your expenses. And so the answer there is yes, but I'd like to know more.
All right, Christian, as well as a few others, have asked this type of a question, so I want to repeat it again. Regarding the 60-40 rule, does it cover every single type of future, including, for example, currency futures, index futures? Are there any exceptions on what the 60-40 does not cover under futures?
Yes, 60-40 does not apply to non-broad-based indexes like spiders, for instance. The SPY is not a non-based, not broad enough for whatever reason to be qualified as 1256. Most of your ETFs fall in that category. Now, I realize I'm getting outside of the definition of futures, but just to be clear, ETFs are not 60-40. Some indexes, most indexes are. The SPX is 60-40, and those broad-based indexes are, but the ETFs are not, like the Qs and the spiders. Those are not.
Right.
And those are the, yeah.
So
those are the
ETFs,
ones.
yeah, but ETFs are ETFs, right? So if it's a future, then it's definitely covered, but if it's an ETF, then it's possibly not covered, right?
Exactly. Well said, yep.
All right. Stephen wants to know about incorporating in different states, like incorporating in a state where there's not a state tax. And I want to tag on to this because I kind of want to know, why is it that everyone incorporates in Delaware?
Oh, good questions. Delaware is great for public companies because they've got some great statutes, great laws on the book. Protecting the board from the shareholders is one. And so Delaware, and it has a no state income tax regime, so publicly traded companies love Delaware. But remember, the IRS doesn't care where you incorporate, but the state sure does. The IRS doesn't care. They're going to get their federal return anyway. But the state of California, for instance, is warning that even if you think about incorporating in another state and reside in California, we will penalize you $10,000. To me, that sounds unconstitutional and a little bit too broad of reach, but you need to be aware who you're taking a stance against if you use multi-jurisdictional strategies. You're posturing yourself not against the IRS, but the state. Now, that doesn't make sense with an LLC, right? An LLC doesn't pay a tax. It passes the tax through to the owners. So it makes no sense to set up an LLC in Delaware, because the LLC in Delaware will pass the tax through to you wherever you live. But if you're talking about a C corporation, then yes, the state of choice makes a huge difference, because the corporation is subjected to the tax of its domicile sovereign of the state. So okay. We do have situations where clients want to incorporate in another state, and as long as they're advised on the risks and rewards of such, we're happy to accommodate. But just realize where those are, and the best entity for most people to trade out of is the LLC. Now, if you need more tax reduction with a C Corp and or a 401k, then what we could do is set up an LLC in your home state, take your office deduction from your very own state. That works very clean, right? You're not trying to claim a home office from a Nevada or Delaware company. You've got your own LLC in your own backyard claiming the home office deduction. But can that LLC be owned and managed by a corporation in another state? Happens all the time. You just need to be aware of the pitfalls and make sure it's structured properly. And it does increase your expenses. You realize that the state allows us to set these entities up. So the state, the Secretary of State, requires that each entity have on file some address, some physical address in that state. That's called a resident agent or a registered agent in some states. It's basically the point of contact for the Secretary of State. And if you're using another state, then obviously you would need to have and hire a resident agent in that state. Online, you can find them for about $100 a year. We offer resident agent services for Arizona, Washington, and Nevada. So
Okay.
hopefully that answers all your questions.
Yeah, and I'm going to sneak in like 2 or 3 more very quick questions, and then we're done. GM wants to know if he establishes an LLC for trading, can he still elect to be treated as a non-professional trader?
That's up to the broker. Like I said at the outset, we had some questions come in that were similar to that. Some brokers, your business, they will maintain the status quo on your fees and your commissions. They don't want to lose your business. Other brokers will default you into professional status, and then sometimes that requires that you link the LLC account to a personal account and get your data from the personal, and then execute your trades from the LLC. But it works.
Okay.
It works rather seamlessly with certain brokers, but that's
So
up to the broker.
Yeah, check with your broker on that. All right, John would like to know. John says he has a TSP account from the U.S. Air Force, and he's now retired. Can he roll that into an IRA, and can he trade from that?
Yeah, you can, John. If you like to sell short, you don't want to sell short from an IRA. A better vehicle may be the 401k, but we would love to discuss that with you in a private consultation. But yeah, I'm pretty sure that that TSP, that government 457 or whatever it is, will be qualified to go into an IRA or 401k.
All right, High Five wants to know, is the $395 the fees for incorporating, is it deductible? I'm sure the answer is yes. High Five also wants to know, do you have to rent space, like physical office space, to start an LLC? I think I can answer that. The answer is no. Correct me if I'm wrong. And then we'll make this the very last question. Dale wants to know, can he rename an existing account for an LLC, or does he have to create a new brokerage account?
Create a new brokerage account with a new tax ID number. Yeah.
Okay.
Now, some brokers will allow you to roll it over and to just seamlessly transfer it, but it definitely is a new account with a new tax ID number.
Okay. So 150 questions or more today. So a lot of people gave their contact info, so I guess Traders Accounting will follow up with you. If you want to contact them, their phone number's on the screen. And also, I want to thank Mirus for doing the introductions today and bringing Traders Accounting here to answer everybody's questions. So big thanks to Mirus. And if you have any questions that are specific to Mirus Futures, then you can contact Bob. I think it's info@mirusfutures.com, and Bob, you can let me know if that's wrong. So thank you, Bob. Bob, your microphone's off, so I'll turn it back on. Thank you, Bob. Sorry about that. And thanks, Trace, for all the time today.
You're very welcome. Thank you, Mike.
Yeah. So I'm sure we'll have you back at some point. And for everybody that wants to rewatch the recording, I'll post it sometime tomorrow on the site. All right, guys. I'll see everybody on the forum. Bye.
Bye-bye.